It's not just about locking in unrealized gains. The put isn't a wasting asset, whether you buy it later or whether you buy it in the beginning. It's a second working asset that you can manipulate in your favor. Of those 12 to 13 income methods I keep mentioning that are in the blueprint, 4 of those are related to manipulating the put option to get a better cost basis, to lower the risk, and potentially bulletproof the trade. It's not a wasting asset, it's a second working asset, where initially we start the position opposite of a covered call. Instead of capping the gains and still taking on 97, 98% of the risk of owning the stock, we're limiting the risk by controlling gains and leaving the upside open. Following those 3 core principles by going further out in time, slightly in the money for that single-digit risk. Now, at the same time, with the ability to do 13 different adjustments against the position. Does it work? Is the put going to lose money if the stock moves up? Yes, but it's designed to be a positive delta position in the proper structure, so I'm always gaining more on the stock than I am going to lose on the put. And because of the proper structure, I can be in a position to take advantage of that at the money bell curve to swap extrinsic value in my favor. What do I mean by that? I've already showed you a married put structure essentially, but locking in gains. We've showed you income method number 1, just selling a call against the married put. That's fairly obvious. It's the first income method. And we showed you the riskless spread trade, the bear call credit spread, income method number 6 against the married put structure, which still gives you premium to lower your risk, lower your cost basis, but leaves the upside open, a benefit of just selling a call to create a collar. But what can I do with the put? How does the buying an in-the-money put translate later on into taking advantage of the at-the-money bell curve? Let's go ahead and take a look historically, shall we? We already saw on the stock chart that right around February 31st, MMYT was trading at about $54 per share at some time during the day, a little bit above $55 perhaps. And let's just use 55, for example, where it closed, or close to it. I was opening a married put. If I got into MMYT on January 31st, I likely would have opened the 60 strike put for August with the stock trading at 55. Now, I say that because it looks like there's just 5-point strike differences. I think the 65 would have been too deep in the money. The 70 definitely too deep in the money. Hey, that concepts are discussed in the blueprint. There is such thing as too little risk by going too deep in the money, and you don't want to do that. Let's take a look at power options. Let's take a look at the chain for MMYT. Now, we're just on a trial account here. But what I want to do is go back in time to the chain using our historical data to January 31st for MMYT. Okay, stock closed at $55.39. It was up $1.34. Instead of using $54 that we used in our example, I'm going to use 55. And what would I have done if I had opened a married put on that day? I would have been out to August, at least 150 days out, following the 3 core principles, the radioactive decay line or the time decay line. And like I said, I probably would have been looking at the 60 strike put, midpoint at 825. Well, that's with the stock at 55.39. Let's keep the math really, really simple. Let's say that I bought the stock at $55 on January 31st, sometimes during the day. And the stock was lower, so the put would have been higher. Let's say that I paid $8.50 for this put. So my total cost basis would have been $63.50 at the time. But remember, my put's $5 in the money, so I'd only be risking $3.25. Yeah, close to about 5.6% on a married put position. Let's go ahead and build that in the profit and loss chart custom spread tool. We're going to enter that we bought 100 shares of stock of MMYT. It helps if I add the stock there at that nice even price of $55. Probably occurred during that day, as we saw it opened around 54, closed at 55.39. Not unlikely that we could have gotten filled on that August 65 strike put. Now it's priced at 889.30, of course, but Our price actually looked like it would have been around 850. And we saw historically that when the stock closed at 55.39, the midpoint here was 820. So with the stock at 55, putting it up to 850, maybe even 875 wouldn't be unheard of. I'd be comfortable going with 9 as well, but for right now, we're going to leave it at 850. Oh, I wanted, my apologies, ladies and gentlemen, I wanted the 60. I'm so sorry. I wanted the 60, not the 65. It was the 60 put we would have paid that 850 for. I am so sorry. How did I get a bulletproof position? You can't do that from the start, by the way. But we have a nice controlled risk, as I mentioned, 5.5, 5. There we go. 350, 5.5 to 5.6%. Perfect. Now, you probably noticed something when I went back in the chain and finally went back to the proper put, didn't you? Did the put decline in price? Absolutely. Midpoint's about 630. I've lost $2.20 on my put. But the stock moved up $5.28. That's what we expect to see. The structure is still putting us in a delta positive position that when the stock moves up, we still expect to make 50, 60, 65% of the unrealized gain in the stock with the put. The benefit was I had a controlled risk of only 5.5% on this trade to begin with. But time value, that's the discussion. Remember that. When we entered this trade, our 60 strike put was 5 points. Let me clear that up. Sorry about that. We bought the stock at 55, theoretically. The 60 strike put is 5 points in the money. The total cost was $8.50, which means what? $3.50 of that price was the extrinsic or time value on the put. My risk, 5.5%. Stock's trading at 60.28. It is where? It's at the money. When the stock was trading at 55, we bought the 60 put in the money following the at the money bell curve. Now that the stock is at 60, the time value has swelled. That put is worth 630. Did I lose 220 on the price of the put? Yes, not saying that. But there is your at the money bell curve in action. When I bought the proper in the money put, the extrinsic or time value or risk was 350. Now it's $6.30. The time value or extrinsic value swelled as the put went from in the money to now at the money. We've gained 280 in extrinsic value. Yes, we lost 220 in time value, but we've gained, more than 220. My apologies. Yeah, we've lost about $5.28 in time value, in intrinsic value, but the extrinsic value moved up 280. Why is that important? Because what's up here now? In the money, 70 strike, which is going to have what? Intrinsic value and a lower time value because it's now on the upper side of the at the money bell curve. So what can I do? I have a cost basis right now of 63.50, a max risk of 350 or 5.5%. One of the 4 ways, really 5 ways to manipulate the put option, just as we saw with locking in gains, now that we have a stock that's moved up in price, I might have targeted the 75 or the 65 strike put. And I'm going to do that here too. What am I going to do? I'm going to sell to close my August 60 put, which lowers my cost basis total in the position down to 57.20. Am I realizing a 220 loss on the put? Yes, for the stock to have moved up $5.28. My overall cost basis in the entire position is lowered to 57.20, stock trading at 60.28. In other words, even if I liquidated this position right now, we would have taken in a profit on the position of that 528 minus the 220 we lost. But I want to stay in the position. I want to keep going, but I want to lower my risk. I'm going to move from the 60 put that we initially entered for August. I'm going to sell to close that, and I'm going to move it up to the 65. Now let's call this 9. Be a little bit favorable. We're going to call it 9. Did I lose 220 on my initial put purchase? Excuse me. Yes. But remember, I had already factored this into my total cost of $63.50. That $8.50, I'm not looking at it necessarily as a loss on the put, because total, I was evaluating my adjustments on the total initial cost of stock plus put of $63.50. I took in $6.30 back, which, as we saw, excuse me, folks, lowered the cost basis down to that $57.20 range. Now I'm going to pay an extra $9, which is going to do what? So we lowered it down to $57.20. I'll pay the $9 to push it back up to what? $66.20, right? But now I have a guaranteed exit of 65. I did this at a debit. I'm paying an extra $2.70 to gain 5 points higher guaranteed payout, which takes my risk, as I mentioned, cost basis of $66.20, new put guarantee of 65, new max risk of 120, or 1.8% on the position. Now, this isn't where I am right now. I'm still up here in the profit zone. Even if I did this adjustment, I could turn around and say, no, I was wrong. Let me sell to close this at 9. Let me sell to close this at 60.28. And I'd still be at a break even or a little bit of profit on the position. I'm not at zero. I'm not down 1.8%. We still have a lot of time left on this put. But what did I do? I swapped time value. That 60 strike put is now out of the money, my original put. That 630 is all time value. When I bought into the married put, the time value with the proper structure was only 350. I'm taking advantage of the at the money bell curve and the swelling of the extrinsic or the time value to go deeper in. Now, this 9 strike put is $4.70 in the money, right? We're at let's call it 60-30. We're looking at the 65 strike. So we're $4.70 in the money right now. The put price is 9, which means $4.30 of this $9 cost is the time value or extrinsic value. I sold to close my put at 630. That's all time value to move into a new time value of $4.30. Positive $2 in time value. Does that show up? It is. What was my original at risk? $3.20 or 5.5%. Now it's down to 120 because I used the put properly as a second working asset to manipulate the time value in my favor. Which is funny when I show this, because everyone who scoffs at the married put idea and says, oh, you're not going to make any money until the stock reaches 66.20. No, that's if I held it all the way to August expiration and did nothing, collected no dividends, sold no calls, moved no puts, did nothing. Yeah, I'd need the stock to be trading at that price. That's not my goal, and that's not the intent. And everyone says, oh, well, you're going to do so much better if you just sell week by week. Well, I'm capping the upside in that case. I'm missing out on the upside opportunity. I'll tell you what, if I sold a monthly 60 or 65 strike call right now, would I get $2? Would I get $2 in time value that I can get back into my position, what I can here by manipulating my put option? Well, one trade and one scenario doesn't the market make. Let's go to March. March 60 call, okay, is at 295, but 28 cents of that. So yeah, we'll get about 250, 270. You do that there. The March 65 call, remember moving up to the 60 strike put for August, but the March is only $1. I gained more extrinsic value and time value swap by rolling up the put. And rather than selling an in-the-money short-term call and getting, 275, 285, let's call it midpoint, rather than $2, I was able to manipulate $2 out of this position using my second working asset, which did what? Left my upside open rather than selling the call. What's your long-term plan? What is your SIGA model for the stock? The current conditions, your expectations, and your goals. Hey, selling weekly covered calls, selling weekly naked puts is not a bad approach, don't get me wrong. But for unrealized profit you have in the stocks that you have an expectation are primed for more growth over a 3, 4, 5 month period, the married put approach is much stronger than covered calls, standard collar positions, out of the money naked puts, and even credit spreads. You're leaving your upside open and you're controlling risk if you're wrong. So that you don't take 10, 15, 20% loss, which I know many of you might have had with covered call positions. Don't worry, I have too. Even with stop orders, even with trailing stops, the unexpected can happen. These types of markets we've seen in the last 4 years, this is the perfect time. Having the unrealized gains after these meteoric rises we saw at the end of December and through January with some of these rocket ship stocks, this is the perfect opportunity. But I also wanted to illustrate that, hey, if I had gotten into this position back at that price in January and we saw close to that Bollinger Band breakout on MMYT, is the put a wasting asset? No, it can be manipulated many different ways, 4 or 5 different ways actually. And that's why the blueprint is important. And that's where the blueprint comes in. Full discussion on the proper structure, the core principles I mentioned earlier, those 3 core principles, when, how, and why to use those 13 different income methods, everything from simply selling a call to doing riskless spread trades, that income method number 6 we showed, the bear call spread, as well as others, broken wing butterflies, condors, and of course, the ratio call spread inside the married put. But there's also that second working asset. Everyone says, oh, it's just wasted money. You've increased your break even too high. Yeah, that's only at expiration. This is a second working asset where if I put the structure correctly, following the rules in the blueprint that apply the 3 core principles, I can manipulate that 3 or 4 different ways, just as we saw, to lower that initial at risk on the position, take it down, and then, of course, in addition, add extra income. I could add an income method number 6 to what we just did on the, that MMYT example that we did here. Sure, I could sell the March call now for $1, 65 strike, get another 60 cents and cut this down to 0.9% while leaving the upside open. And we showed that with the other example. This is if we had bought the stock back in January. Yeah, we'll get $1 here and we'll pay 35 cents here, as we saw with that other bear call spread income method number 6. But in this context, takes it down to only 50 cents of maximum risk, not quite bulletproof, but leaves the upside open, generates some credit to lower that risk further, and leaves the infinite upside as well.